Let me tell you something that's going to sting a little. The reason you're losing money isn't that you don't have enough indicators. It's that you have too many. Right now, there are traders watching this with 8, 10, 12 indicators stacked on a single chart. RSI, stochastics, MACD, Bollinger Bands, 3 moving averages, a cloud they don't understand, and an oscillator they added last week because somebody on the internet swore it was the secret. And they are still losing. In all my years in this business, through every boom and every bust, I never once traded off a screen that looked like a Christmas tree. I read 3 things, only 3. The same 3 I'm going to hand you today, the 3 that actually work, right after I show you why everything else on your chart is quietly lying to you. So, before you touch another indicator, give me the next few minutes. They may be worth more than the last few months of your trading. If you've spent any time on this channel, you already know my name and you know how I trade. I'm not here to rehearse my story again. I'm here because the markets haven't changed, not really. The tickers turned into screens, the telephones turned into apps, the crowd got faster and louder, but human nature didn't change one bit. Fear is still fear, greed is still greed, and the market still moves for the exact same reasons it always has. And if you're newer here, I've already laid a lot of the groundwork for what we're about to do. I've got a full breakdown on how to actually read RSI instead of blindly selling at 70. I've got one on using the moving average the right way, and another on reading support and resistance straight off the chart. They're all linked for you in the description and up on the screen. Watch them when we're done here, because everything I say today builds on them. That's the first thing I need you to understand. Every modern indicator you've ever loaded onto a chart was built on top of 2 pieces of information that have existed since the very first trade ever made. Price and volume. That's it. Every oscillator, every moving average, every fancy tool with a Japanese name, all of it is just price and volume run through a formula, dressed up to look like a crystal ball. So, when you stack 12 indicators on your chart, you are not getting 12 different opinions. You are getting the same 2 pieces of information repackaged 12 times, each one lagging a little more than the last. You've built yourself an echo chamber and called it analysis. Here is why 90% of traders fall into this trap, and I want you to listen closely because this part is about you, not about the tools. Traders don't add indicators because indicators make them money. They add indicators because indicators make them feel safe. Every new tool feels like one more layer of certainty between you and the fear of being wrong. You tell yourself, if I just had the right combination, the right settings, I'd finally stop guessing. So you keep searching, you keep adding, and the more you add, the more confused you become. Because when you have 12 signals, you will always be able to find one that agrees with whatever you already wanted to do. That's not analysis, that's permission. You're not reading the market. You're hunting through your indicators for an excuse to take the trade your emotions already decided on. I watched men ruin themselves this way in my time, and I see you doing it now. They didn't lose because the market was unbeatable. They lost because they drowned the one clear voice the market was giving them, the voice of price and volume, under a pile of noise they mistook for wisdom. Let me give you the hard truth, the one that took me years and several fortunes to learn. The market is always telling you exactly what it's doing. The problem is never a lack of information. The problem is that you've covered it up. There's a second trap, just as deadly. It's the lag. Most of those indicators are calculated from data that has already happened. By the time your favorite oscillator flashes a signal, the move it's reacting to is often half over. You end up entering late, exiting late, and wondering why the market seems to reverse the moment you commit. It isn't conspiring against you. You're simply reading a clock that runs a few minutes slow and trying to catch a train with it. So, what's the answer? It is not to find a better indicator. It is to delete almost all of them and return to the only things that have never lied to a trader in 100 years. Over the next few minutes, I'm going to give you the only 3 tools you actually need. First, price action and pivotal points, the master signal, the one thing that actually pays you. We'll talk about how to read what the market is doing without a single oscillator, and how to find the precise levels where the big money shows its hand. Second, volume, the truth serum. Price tells you what is happening. Volume tells you whether to believe it. I'll show you how to tell a real move from a trap, the way I did when I was reading the tape. And third, the moving average, what I always called the line of least resistance. Not as a magic buy and sell signal, but as a compass that keeps you on the right side of the trend so you stop fighting the very current that's trying to carry you to profit. 3 tools. That's all. And by the end, I'll show you how they fit together into one clean, calm way of reading any market on any time frame, so you can finally close those 12 windows and breathe. Now, before we go further, I want to point you to something. Everything I'm going to teach you today sits on top of a foundation, a way of thinking about markets, about discipline, patience, and risk. The tools are only as good as the mind holding them. If you want that full foundation in one place, my complete philosophy has been put into an ebook called Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. It's the why behind the what. You'll find the link waiting for you in the description below. Grab it now, keep it open while you watch, and the lessons in this video will land twice as hard. So, close the extra windows, clear your chart down to the bare candles, and let's begin where every honest trade begins, with price itself. Let's start with the first tool, and in many ways the only one that truly matters, price. I want you to sit with that word for a second, because everything else we talk about today is going to orbit around it. Price is not an indicator. Price is the thing every indicator is trying and failing to describe. When you watch an oscillator, you're watching a shadow on the wall. Price is the thing casting the shadow. So, why would you spend your day staring at the shadow when you could turn around and look at the thing itself? Here is what price actually is. It is the single point where every buyer and every seller in the entire world agreed to do business right now, in this moment. Every hope, every fear, every piece of news, every big funds decision, every panicked retail trader, all of it gets compressed into one number that ticks up and down in front of you. Price is the verdict. It's the market casting its vote in real time. And your only job, the entire job, is to read that verdict honestly and decide whether to side with it or stand aside. Most traders never learn to read price because they were taught backwards. They were taught to ask an indicator for permission. The chart turns up, but they wait for the oscillator to turn green. By the time it does, the easy money is gone. They've trained themselves to trust a lagging formula over the living, breathing truth right in front of them. I want to retrain you, starting now, to trust the price first and let everything else merely confirm. Now, reading price is not about predicting the future. Let me kill that fantasy right here. I never knew what the market was going to do next. Not once in my life. Anyone who tells you they can predict the next candle is either fooling you or fooling themselves. What I learned to do instead was to read what the market was doing right now, in the present, and to position myself on the side of the path of least resistance. That's a very different skill from prediction, and it's a far more profitable one. So, how do you read price without a single indicator? You start with structure. A chart, stripped bare, is just a story of where buyers and sellers fought and who won. When price makes a high, then pulls back, then makes a higher high, the buyers are winning. They are willing to pay more and more. That's an uptrend, and it isn't complicated. When price makes a low bounces, then makes a lower low, the sellers are in control. That's a downtrend. The market is not hiding this from you. It's printing it right there in plain sight, candle after candle. Higher highs and higher lows, you side with the buyers. Lower highs and lower lows, you side with the sellers. When it's doing neither, when it's just chopping sideways in a range, you wait. Most of a trader's losses come from forcing trades in those sideways messes where there is no verdict yet. But the real edge, the thing I built much of my career on, came from something more specific than just trend. I called them pivotal points. And I want to give this to you carefully because once you see it, you cannot unsee it. A pivotal point is a price level where the character of the market changes. It's a line in the sand. It's a level where if price crosses it, the whole story flips and the market tends to move with speed and conviction in the new direction. Think of it as the spot where the market finally makes up its mind. Below that line, the sellers had the upper hand. Above it, suddenly the buyers do, and everyone who was doubting rushes to get on board. That rush is where the money is made. How do you find these levels? You look for the obvious places where price has reacted strongly before. A ceiling that price has slammed into 2 or 3 times and failed to break. That's a pivotal point. The day it finally breaks through that ceiling on conviction, that ceiling becomes a floor, and the path of least resistance is now upward. A floor that price has bounced off repeatedly, that's a pivotal point too. The day it finally cracks and falls through, that old floor becomes a ceiling, and the easy path is now down. These are the levels the entire market is watching, whether they admit it or not. They are where the big orders sit. They are where the stops are stacked. They are where careers are made and broken. Now, I'm going to tell you the single most important thing I ever learned about these levels, and it cost me a fortune to learn it, so take it for free. The breakout itself is not the signal to celebrate. The behavior after the breakout is. When price pushes through a major pivotal point and then keeps going, expanding, not looking back, that is the market confirming its decision. But when price pokes above the level, then immediately sags back below it, that is the market changing its mind, and that is a trap that will eat your account alive. I learned to wait for that confirmation. I learned that there was no shame in letting the first little bit of a move go by in exchange for the safety of knowing the move was real. This is what separates the patient trader from the gambler. The gambler buys the moment price touches the line, betting it'll break. The trader waits for price to prove it has broken and then commits with size. Yes, you give up a few points of entry, but you trade away a guess for a near certainty. And over 1,000 trades, that trade-off is the entire difference between an account that grows and an account that bleeds. Let me walk you through what this looks like in real life without a single indicator on the screen. Picture a stock that's been grinding sideways for weeks. It keeps running up to $40 and getting rejected. 40 rejected, 40 again rejected, 40 a third time rejected. Every trader watching that chart now has $40 burned into their mind. That is your pivotal point. And you don't need a tool to mark it. You can see it with your own eyes. Now, you do nothing. You wait. You let the market come to its decision. One day, the stock pushes up to 40, and instead of getting rejected, it slices clean through to 41, 42, and it holds there. It does not fall back. The character has changed. The ceiling just became a floor. That is the market handing you a verdict in plain language. And now, only now, you act. You didn't predict it. You didn't guess. You waited for the truth, and then you moved with it. That is price action. That is reading the tape, just modernized onto your screen. No oscillator told you to do that. No indicator could have given you a cleaner signal than your own eyes reading the structure of the market. But here's the thing, and this is the bridge to our second tool. When that stock broke through 40, how do you know whether it was the real move or the trap? How do you tell the difference between a breakout that's going to run for weeks and one that's going to suck you in and reverse the next morning? Price alone gives you the what. It tells you the level broke, but it doesn't always tell you whether to believe it. For that, you need a second witness. You need something that reveals the conviction behind the move, the force behind the verdict. And that, my friend, is the one piece of information that cannot lie to you. That's where we turn next. The second tool is volume. And if price is the verdict, then volume is the conviction behind it. Price tells you what the market decided. Volume tells you how much it meant it. Let me explain why this matters so much. Because most traders glance at those little bars at the bottom of the chart and never truly understand what they're looking at. Volume is simply the number of shares or contracts that changed hands in a given period. But think about what that really represents. Every unit of volume is real money putting itself at real risk, taking a real position. Volume is the footprint of effort. It's the market showing you not just what it decided, but how hard it pushed to get there. And effort, my friend, is the one thing that's very difficult to fake. Price can be nudged. A thin, quiet market can drift up on almost no buying at all because there's nobody there to sell into it. That kind of move looks identical to a powerful rally if all you watch is price. But put volume underneath it and the illusion shatters. A move on heavy volume is the market voting with its full weight behind it. A move on thin volume is a whisper pretending to be a shout. Once you learn to hear the difference, you will stop falling for half the traps that are currently emptying your account. Now, let me take you back to that stock breaking through 40, because this is where volume earns its place as our second witness. Price pushed through the ceiling. Good. But I told you that price alone can't always tell you whether to believe the move. Here is how volume answers that question. When that stock breaks through 40 and the volume bars surge, swelling far above their recent average, that is the market roaring its agreement. That is thousands of participants rushing in, committing real capital all at once to push price into new territory. That breakout is real. The conviction is there. The big money is participating, not just a handful of small traders nudging the price. When you see price break a major level on a surge of volume, you have your two witnesses agreeing. and that is when you commit with confidence. But now picture the opposite. The stock creeps up to 40, edges through to 41, and the volume bars stay flat, limp, below average. No surge, no roar, just a quiet drift higher on almost nothing. That should make the hair on your neck stand up, because a breakout with no volume behind it is a breakout nobody believes in. The big money isn't there. It's a hollow move, and hollow moves collapse. That is precisely the kind of breakout that pokes its head above the level, sucks in all the eager traders who were watching 40, and then sags right back down the next morning, trapping every one of them. Volume would have warned you. Volume would have told you to stand aside. This is the heart of it. Price and volume together tell you a far truer story than either one alone. Price gives you direction. Volume gives you validation. A rising price on rising volume is healthy, sustainable, real. A rising price on falling volume is a warning that the move is running out of fuel, that the buyers are getting tired, that the rally is being held up by fewer and fewer hands. The same logic works in reverse on the way down. A market falling on heavy volume is under genuine aggressive selling. A market drifting lower on light volume may simply be a lack of buyers for the moment, not real distribution, and it may snap back the instant a bid returns. Let me give you a few of the most valuable patterns, the ones I want burned into your memory. First, breakouts. A breakout through a pivotal point should be accompanied by a clear expansion in volume. No volume, no trust. It's that simple. Make it a rule. Second, the trend continuation. In a healthy uptrend, you want to see volume rise when price moves in the direction of the trend, and volume fade when price pulls back against it. That tells you the pushes are powerful and the pullbacks are just gentle profit-taking, not real selling. When that relationship inverts, when the pullbacks suddenly come on heavier volume than the rallies, the trend is in trouble. The conviction is shifting. Pay attention. Third, and this one is subtle, but it saved me more than once, the climax. Sometimes after a long extended move, you'll see a violent explosion of volume, far larger than anything before it, with price lunging in the direction of the trend. New traders see that and think the move is just getting started. Often, it's the exact opposite. That spike is frequently the sound of the very last buyers piling in at the top, the latecomers, the ones who couldn't stand to miss out any longer. When the last buyer has bought, who is left to push the price higher? No one. And the market rolls over. A volume climax at the end of a long move is often exhaustion, not strength. Learn to feel the difference between volume that's launching a move and volume that's ending one. Now, I want to connect this to something deeper because I don't want you to just memorize patterns. I want you to understand the why beneath them. Back when I traded, we didn't have these neat bars on a screen. We read the tape, the actual ticker tape, watching the size of the transactions roll by, feeling the rhythm of the market speed up and slow down. When the tape started running fast and heavy, you knew something real was happening. When it went quiet and thin, you knew the market was just marking time, and you kept your hands in your pockets. What you have on your screen today, those volume bars, is the exact same information I was reading by hand 100 years ago. The technology changed. The truth did not. Volume is, and always has been, the market revealing its true intentions, separating the moves it means from the moves it's only faking. And here is the discipline that volume forces on you, which is really the discipline I want this entire channel to instill. Volume teaches you to wait for agreement. It teaches you not to act on price alone, on a single piece of evidence, on a hunch. It teaches you to demand that the market show you both the direction and the conviction before you risk a single dollar. The trader who waits for both witnesses to agree, price showing the break and volume showing the force, takes far fewer trades. But the trades he takes are the good ones. And in this business, taking fewer, better trades is the whole game. Patience isn't passive. Patience is you refusing to act until the evidence is overwhelming. So now you have two of the three. You can read price to find the verdict and the pivotal levels where the market shows its hand. And you can read volume to know whether to believe that verdict, whether the conviction is truly there. For a great many traders, those two alone, mastered properly, would transform their results entirely. If you took nothing else from this video, but price and volume read together, you would already be ahead of 90% of the people you're competing against. But there's a third tool, and it solves a problem the first two don't fully address. Price and volume are brilliant at telling you what's happening right now, in this moment. What they don't do on their own is keep you anchored to the bigger picture. They don't easily answer the question, am I trading with the larger current or against it? Because here's a trap even good traders fall into. You can read a perfect breakout on perfect volume and still lose if you took that trade against the dominant trend, swimming against a tide far stronger than your little setup. You need something to keep you oriented, something to keep you honest about which way the river is truly flowing. And that is the final tool we turn to now. The third tool is the moving average. And of the three, this is the one most traders abuse the worst. So, I want to be very careful about how I hand it to you. Because used the wrong way, a moving average is just another lagging line that gets you chopped to pieces. Used the right way, it becomes something I valued more than almost anything else in my trading. It becomes your line of least resistance. Let me first tell you what a moving average actually is, in plain language, because the name confuses people. A moving average simply takes the price over the last so many periods and averages it, then plots that average as a smooth line that follows price along. As each new candle forms, the oldest one drops off and the newest one gets added, so the line moves along with the market. That's all it is. It's not magic. It's just price smoothed out so you can see the forest instead of getting lost in every individual tree. And that, right there, is the entire value of it. Price by itself, candle to candle, is noisy. It jumps around. It feints and fakes and zigzags. And in all that minute-to-minute noise, it's easy to lose your sense of the bigger direction. The moving average cuts through the noise and shows you the underlying current. It answers, at a single glance, the one question that keeps even good traders out of trouble. Which way is the river actually flowing? Now, here's where most people go wrong. So, listen closely. They try to use the moving average as a buy and sell trigger. Price crosses above the line, they buy. Price crosses below, they sell. And then they get destroyed because in a choppy, sideways market, price crosses back and forth over that line a dozen times, and they get whipsawed on every single one. They take a lagging tool built to show the big picture, and they try to use it for precise timing, which is the one thing it was never built to do. That is like using a compass to measure the length of your desk. Wrong tool for the job. You already have your timing tools. Price action gives you your entry at the pivotal point. Volume gives you your confirmation. The moving average is not for timing. It's for direction. It's for context. Keep those jobs separate, and you'll never misuse it again. So, here is how I want you to use it instead. Think of the moving average as a single clean filter laid over everything else you do. When price is trading above a rising moving average, the current is flowing up, and your job is to be looking for buying opportunities and buying opportunities only. When price is trading below a falling moving average, the current is flowing down and you should only be looking to sell or to stand aside. That's it. The moving average doesn't tell you when to pull the trigger. It tells you which direction you're allowed to point the gun. It keeps you trading with the dominant force instead of against it. Remember that trap I warned you about at the end of the last point? The trader who reads a perfect breakout on perfect volume and still loses because he took the trade against the larger trend? This is the tool that saves him. Because before he ever takes that beautiful looking long trade, he glances at his moving average, sees that price is below it and the line is sloping down, and he realizes he was about to buy into a falling market. The setup looked perfect up close, but he was swimming against the tide. The moving average pulls his head up out of the water and shows him the whole ocean, and he stands aside and he keeps his money. That is the role of this third tool. Not a trigger, a guardrail. It keeps you honest about the bigger picture so that your price and volume signals are taken in the right direction, in harmony with the trend, rather than in defiance of it. It is the simplest of the three, and yet it may save you from more bad trades than the other two combined. Because the single most expensive habit a trader has is fighting the trend, convinced he's smarter than the market. The moving average is the humble line that reminds you every single day that you are not. Now, let me bring all three together because this is where it all becomes one method instead of three separate tricks. This is the whole system, and I can give it to you in 3 steps. Step 1, direction. Before anything else, you look at your moving average. Which way is the river flowing? If price is above a rising average, you are hunting for longs. If it's below a falling average, you are hunting for shorts. If the average is flat and price is tangled all around it, the market hasn't decided, and you wait. This step alone keeps you out of most of the trouble you've been getting into. Step 2, location. Now that you know your direction, you turn to price action and you find your pivotal point. The key level, the ceiling that, if it breaks, flips the story, the floor that's been holding. You mark the line in the sand where the character of the market will change. You don't act yet. You simply wait there, at the level, patient, like a hunter who knows the path the deer will take. Step 3. Confirmation. Price reaches your pivotal point and pushes through. Now you look to your volume. Is the move backed by a surge of real conviction, or is it a hollow, low-volume drift? If the volume roars and price holds beyond the level, all three of your witnesses are now in agreement. Direction, location, and conviction have aligned. And that, finally, is when you act. With confidence, with size, and with a clear place to put your stop, just back on the wrong side of the level you traded. Direction, location, confirmation. The moving average, price action, and volume. 3 tools, 1 decision. No clutter, no contradiction. No 12 windows screaming different things at you. Just a calm, repeatable way to read any market on any time frame, the same way I read the tape for 40 years. You can drop those 3 onto a 1-minute chart or a weekly chart, on a stock or a currency or a commodity, and the logic never changes because it isn't really about the tools at all. It's about reading the intentions of the crowd. And the crowd has behaved the same way since the beginning of markets. But I have to leave you with a warning, and it's the most important thing I'll say in this entire video. These 3 tools will not make you money on their own. Let me say that again because it's the lesson that took me the longest and cost me the most. The tools are not the edge. You are the edge, or you are the leak. I have seen traders with this exact method blow up their accounts because they had the signals right and the discipline wrong. They jumped the gun before confirmation. They risked too much on a single trade. They held a loser hoping long after the market had told them they were wrong. They let one emotional decision undo 100 good ones. The tools point the way, but it's patience, discipline, and the management of your risk that determine whether you actually arrive. That is exactly why I put my second ebook together and why I want you to have it. It's called the Livermore Journal, a 90-day trading psychology workbook. The first book I mentioned, Thinking Like Jesse Livermore, gives you the mindset. This one makes you live it. It's a 90-day workbook designed to be filled in trade by trade, day by day, so that the discipline stops being something you read about and becomes something you actually do. You'll track your trades, your reasons, your emotions, your mistakes, and over 90 days you will watch your own patterns reveal themselves on the page. That is how a method like this one actually becomes a habit. Both books are linked for you in the description, the mindset, and the workbook, and I'd take them together if I were you. So that's it. The only 3 indicators you'll ever truly need. Price action to find the verdict and the level. Volume to confirm the conviction behind it. And the moving average to keep you flowing with the current instead of fighting it. Delete the rest. Clear your charts. And start reading the market the way it's actually speaking to you, instead of asking a dozen lagging tools for permission you never needed. If this changed the way you see your charts, then you're going to want to watch the deep dives I've done on each of these tools on their own, because there's far more in each one than I could fit here today. I've linked the right ones to watch next right on your screen now. Subscribe to Jesse Livermore's trading codes so the market never catches you unprepared again, and I'll see you in the next one. Trade with patience, protect your capital, and let the market come to you.